Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Mr. Powell's testimony in front of the US Congress was the talk of the town yesterday, but largely kept the markets unshaken. Why, you may ask? Because it seems he stuck to the script. In the entire conversation about rate cuts, Bloomberg publishes a financial condition index, essentially a score tracking the level of financial stress in the US asset markets to help assess the availability and cost of credit. This particular score indicates that the financial conditions now are significantly easier than when Fed even started tightening. Good morning, JK. Yesterday, a lot of data on the labor market from the US as well as Powell's testimony. What's your interpretation of both?
Good morning, Swaraj. Yes, I think it's been a very busy week and it will continue to be busy tonight as well as tomorrow because more events are lined up. Of course, yesterday, apart from the labor market related data, yes, Fed chairman's testimony to the Congress was the focus of the market, and he actually stuck to the script, as you said. And express that they want more confidence on getting the inflation back to that target. And yes, if the economy evolves broadly as expected, that will likely appropriate to begin dialing back policy restraint at some point in this year. This means that there is no dovishness from Powell, freshly, or even that could have normally been a disappointment to the market, but that was not to be, because what the market got from it was that, yes, the next move from the Fed is going to be a cut, and that's, the timing of that is what is under deliberation. Now, when you look at the US economic data, apart from the inflation, which came marginally higher, and also the last month's unemployment report, which came very strong, most of the other indicators have been weaker, giving a sense that economy could at last have been starting to slow down. Yesterday, we did have the labor market data on ADP jobs report, where the number was at 140,000, and that was below the estimate of 150,000, what the market was expecting. Definitely, it was higher than last month, but that is not something, a very high number that would concern or give rise to a high number on the jobs data on a Friday. Then the JOLTS data, monthly number, which indicates the vacancies in the US economy as well as the quits. Both of them were somewhat weaker, not very big weakness, but some weakness. Job openings declined, to 8.86 million, 8.89 was the previous month. And layoffs also fell modestly. But the number of Americans quitting the jobs, a sign of confidence they can find higher pay or better working conditions, were also lower. Now, just to give you a perspective, job openings have declined since peaking at a 12 million record in March 2022 as the economy roared back to strength from COVID-19 lockdown, but they remain at historical levels. Before 2021, monthly openings had never topped 8 million. So it's still, on a broader basis, it is tight, but there are signs that it is easing out. Now, even if you recall, the services PMI from ISM also showed the employment component slipping into contraction territory at 48. So all the leading indicators into the non-farm payroll data on Friday are soft. So logically, you would expect a softer number, but now, after having seen the big beat last month versus expectation, market would remain skeptical what the number would be. Yes, there are interpretations saying that the last month numbers were also, not very strong as the headline indicated, but we'll just see how the number comes day after tomorrow. Yeah, in the meantime, we have, had more number from Eurozone, which indicated that the economy has been, doing better, after the Eurozone manufacturing activity pickup to a 7-month high in February, coming at 50.2 from 48.4 in the previous month. And this adds to the stream of good data that has been coming. Now, another number I want to point out is the Germany's trade surplus, which increased to 27.5 billion in euros, that is in January 2024. 21.5 was the number which was, in the previous month. Now, exports have risen by 6.5%. Now, Germany's increased exports and better trade number is not something that we can ignore. So this adds to the recent a stream of good data from Europe. I think green shoots are increasing. I think IFO number as well as the ZU number were also good. There seems to be a turn in the cyclical indicators for Eurozone that has been supporting the single currency. Of 75 central banks, they prefer to increase their holdings in European assets as well as increase their reserves in euro. So this is a fundamental backdrop for euro recovery in the recent times, despite their growth remaining flat, Germany in recession. So I think forward looking, they are expecting Eurozone to bounce, not only bounce, but also the structural position of euro is much better in terms of the current account trade number and all that. Whereas for US, everything has been good, but that has been discounted. So that is how it is. Yes, on the UK side, we had budget that was presented by Mr. Hunt. That was a spring budget, and he delivered services and more investments while increasing, the forecast of the economy's growth by 0.2% by meeting the fiscal rules. He also projected 2024 growth to 0.8% and for 2025 by 1.9%. You should remember that economy had entered into a recession in the second half of 2023. So the numbers from Europe as well as UK being very encouraging, gave rise to these currencies rising through some strong resistance at 1.09 for euro and 1.27 for pound, and those levels are holding around those levels. And Japanese yen also strengthened to around 148.5. This is on the back of the yields that came off in the US recently. Although towards the end yesterday, 2-year yields slightly went up, but the long-term yields, 10-year and 30-year, were down. And in Japan, there is also a report saying that one of the industries has been able to strike a deal with their workers for wage increase, which has been as per their demand, and that we all know that Japanese central bank has been linking their policy move to the wage settlement that is ahead. In fact, among the Japanese authorities, there has been two groups, one pushing for changing the policy early and the other wanting to wait for more time. So overall, the picture is and was somewhat negative for the dollar. And that's what we have been seeing. Gold, of course, made a new all-time high again yesterday, consolidating around those levels, not really falling off from the levels, except some mild profit taking. So expect more of the same in the coming days. Technically, the setup looks for dollar to break out on the downside. 102 index. On the rupee, of course, we did have a slight weakening of the USD INR towards 82.82 with the less intense buying from PSU banks, and also the dollar index falling was another trigger. Of course, 82.80 has been holding. Powell's testimony did not offer anything new to the market, but in the offshore trading as well, the rupee was holding around 82.80. On the domestic news, composite PMI in India was revised downward to 60.6, but that is still well into the expansion territory. So what we have for the rupee is influence from US employment data that can hold influence for the Fed rate cuts, as well as the March year-end related flows that can actually put some pressure on the USD/INR to the downside. Technically, as I have been saying, 82.70 is a level where central, break of that indicates that central bank is comfortable allowing some strength in the INR, particularly if it is accompanied by dollars overall weakness, or a break above 83.20 looks very unlikely as of now, unless there is a dollar strength emerging due to a risk aversion or a black swan event. Thank you.
Thank you, Jake. And quickly summarizing, the US Fed chairman's testimony was as expected. So what he's been saying is that there is more confidence needed to get inflation back to the target. And that will be the likely case if the economy broadly evolves as it is evolving. But other indicators of the US economy, it is showing some signs that the economy is weakening. Even JOLTS data yesterday was somewhat weaker, but only a slight modest weakening. Job openings have declined, but still remain quite elevated compared to pre-COVID levels. So now NFP on Friday would be something markets would be looking at, and today we have the Eurozone interest rate decision, and that's something markets would be looking forward to. Gold made a new all-time high yesterday, and for rupee, rupee has been trading stronger at around 82, 82. Uh, so fall in dollar index has mainly resulted in this. And break of 82.70 accompanied by general weakness in the dollar can lead to further appreciation in the rupee. That's it from us today. Thanks for listening. Tune in tomorrow. Tune in on Monday as we go on a long weekend. Tune in on Monday for the latest in the financial markets.